This ETF has beat the S&P 500 over 3 years, over 5 years, over 10 years. And it's the perfect example to help us understand what's going on in the market recently, and that actually might help us frame and understand what we want to do individually going forward from now. So in this video, we're discussing the iShares S&P 100 ETF, which is ticker symbol OEF. We'll also be comparing it to the iShares Core S&P 500 ETF, which is IVV. This one can actually be compared to VOO or SPY. It's essentially the S&P 500. We'll be comparing these to the iShares Russell 1000 ETF, which is IWB. The ETFs we're talking about today, they are all iShares. They're all the same fund family. So we are focusing on one fund family. There's some pros to this. You're gonna see one later on in the video. But really, what we're kind of talking about here is we're talking about the largest 100 stocks, then the largest 500 stocks, and then the largest 1,000 stocks. That's how these ETFs are working. And then what we're gonna do here is after we compare OEF, IVV, and IWB, I'm gonna go over my ranking process and I'm gonna show you a clear winner, which one is better based on the way I rank ETFs. After that, I'm gonna show you my free web app that's gonna show you how I do this basically just with a few clicks of a button. I'm also gonna compare an ETF called IWY, which has done very well. And that's gonna also help us put into context what's been going on. And then finally, I'll tell you why I'm not putting money into OEF. I always like to start with the expense ratios of the ETFs. So that's the first thing we'll go over in the ranking process. IVV, or the S&P 500 type of ETF, is 0.03%, IWB 0.15%, OEF 0.20%. Again, IWB is the top 1,000 stocks, OEF the 100 largest stocks, and then IVV, which is like VOO, it's the S&P 500, the top 500 largest stocks. I don't want to keep repeating that, but iShares does not have a good naming system. Like for example, like the spider ETFs like SPY, SPYG, S&P 500 Growth, SPYV, S&P 500 Value. Its naming system's good. iShares is not. So it gets a little confusing. But next we're going to talk about yield. So the yield on these, so IVV is 1.13%, IWB is 0.97%, and OEF is 0.78%. Now one of the advantages that I was talking about for using iShares is that we can use all of these ETFs together and they have a pretty long history for an ETF. So we can actually go back to October 27th of the year 2000 and see what the maximum drawdown of these ETFs were because they're pretty old ETFs. And so what we're doing in this section is we're talking about risk. In particular on this part, it's how much the ETF fell from a peak to a trough over any amount of time. Could be a year, could be 5 years, doesn't matter. It's just how much it fell. And so what we have here is a negative 54.12% for OEF, negative 54.12% for IWB as well, and then negative 55.25% for IVV. Now, these happened during the financial crisis where everything was down. This pretty much tracks the market, right? Market lost about just over 50%, and so did these other ones, right? IVV being the market, IWB and the OEF also lost around the same amount. So we would call this a wash. Then we want to talk about volatility. So this can help us understand the volatility of the prices of these ETFs. So which is more volatile? IVV is the least volatile. That's the S&P 500 one at 15.27. IWB, which is the Russell 1000 or the 1,000 largest, that's 15.45%. And then OEF, the largest 100 stocks, is 16.23%. These volatility numbers aren't very different. They're pretty close, so I would also call this pretty similar. Diversification, how many holdings are in each of these? OEF has 105. Remember, it's the top 100 largest. IVV, 508. Again, top 500 largest. IWB, 1019, top 1,000 largest. Next, we have assets under management. So how much money are in these funds? So OEF is the smallest, 29 billion. IWB next at 45 billion, and then IVV at 724 billion. These are all pretty decent size ETFs, so you wouldn't like consider these like really small ETFs. They're pretty decent. It's just when you look at IVV, it looks like the other two are small, but having $30 billion almost in the ETF, that's a good size. Okay, let's talk returns. I alluded to this earlier and how the returns are. So 21.36% over the past 3 years is IWB. So that's the 1,000 largest stocks. Next, still over the past 3 years, the rate of return, 21.83% for IVV, the S&P 500 ETFs. And then next, 26.31 OEF, the 100 largest stocks. So OEF did the best. And it had a great return, 26%, amazing. And also 21% is also amazing, right? And then next, if we look at the 5-year return, 15.10% IWB, 15.80% IBV, 17.65% OEF. So again, OEF having the better return here. And then we have the 10-year return. So annually over 10 years, you would have made 14.56% with IWB. You would have made 14.92% with IBV and 16.15% with OEF. So OEF did outperform the general S&P 500 and the top 1,000 largest, or like the Russell 1000 index. Next up, let's see the growth of $10,000. So how much would $10,000 grow to, just so we could put this into money. So IWB, $10,000 would have grown to $38,933, IBV, $40,176, OEF, $44,676. Now, here comes today's lesson and how to structure and framework what's going on in the stock market. This is the past 3 years, right? We just went over this, but this is another way to look at it. On the left side, the return, right? Between 10% and 30% annual rates of return. On the bottom, smaller or larger companies. So what do we have? IWB has 1,000 companies in it, and it's the 1,000 largest. So the average company in IWB is actually a bit smaller than the average company in IVV, because IVV is the 500 largest. And then next up, OEF is of course even larger companies with only 100 of the top largest companies. So what happens is the average stock in these ETFs, it's smaller in IWB, larger in IVV, and then the largest in OEF. And then we can see the return goes up the larger the companies are in these things. And that's what's been going on. IWB 21.63, IVV 21.83, OEF 26.31. Larger companies have done a bit better. It also happened over 5 years. IWB, IVV, OEF. It's also happened over 10 years. IWB, IVV, OEF. So what's going on? It just so happens that over the past 10 years, maybe 15 years, large companies have done way better than smaller companies and mid-sized companies. It's almost like the larger the company you have inside a broad index, the better it's going to do. And here we need to understand factors when it comes to the stock market. So there are all these different factors in the stock market. There's size, there's quality, there's momentum, there's value, or let's say style, which would be like value or growth stocks. There's also high quality, there's volatility. So there are these factors in the stock market. What we need to understand is that the S&P 500 is actually weighted based on size. It tilts to the size factor. It is the market, but it also has larger companies in it than the general market, right? So let's just say the market is the S&P 500 and we're basing everything on that. Well, OEF would be tilted more towards larger companies, large size. On the other side, IWB would be tilted towards smaller companies, right? So that's a factor. Its size is a factor. And within the factor of size, larger companies doing better over the past 10 years than smaller companies. And small cap stocks have done awful over the past 10, 15 years. And so when we look at our returns in our portfolios and our ETFs, we have to kind of understand that no matter what we look at, this is kind of just always gonna be the case in different places. Like if you're just looking at a normal broad market ETF, it's gonna always kind of look the same. You had a bunch of large companies, if it's diversified, it's probably gonna do better than the one with a bunch of small companies. And it's just kind of because of that size factor. But there's also other factors that we can consider. So I'm gonna show you my web app real quick. And so the way this works is what I would do is I would say I'm looking at this through a growth lens today because I care about just the general return and growing my assets. I don't care about like how much income it's producing. I just care about the rate of return, the total rate of return. And then I go down here and I say, I want IVV, OEF, IWB. I hit enter, and then I hit compare. And this is gonna do everything I just did. It's going to take all of those little pieces of data and it's going to rank this based on my ranking system. Now, here we have a winner, OEF. OEF is number 1. Then we have IVV, the S&P 500 tracking ETF is number 2, and IWB is number 3. So the way I've created this thing is that it takes into consideration the risk that this thing takes, all these ETFs take, but also the returns. And as we could see before, if we go down here and we take a look at the risk, we know the volatility is like pretty much very close, right? They're all within like 1 percentage point. And same with the max drawdown. We could see the max drawdown is pretty much within like 1.5 percentage points. So they're all very close on risk, Therefore, the returns were the ones that helped us rank this thing. The expense ratio is also part of it here, and there's some other things too, but essentially OEF ends up winning. Now, what happens if we add another one in here? Now this one is IWY. So now I have IWY. IWY is the iShares Russell Top 200 Growth ETF. The way to think about this thing is that it has large companies, but they're also tilted to growth. And so here we have our next part of this. The size factor has outperformed. But then over the past 10 years, the growth factor has also outperformed. So if you tilted towards growth instead of just the broad market, you also likely would have outperformed. We could throw another one in here. Let's throw in IVW. I click compare. So IVW is going to be down here. And IVW is like the S&P 500 growth. So the average stocks in it are gonna be a bit smaller. And because of that, the return is a bit less. So we have like, you get larger, but then you have growth, that wins. Having a bit smaller, but also growth, IVW, which wins against having IVV, which is the S&P 500 general stock market, which wins over just having the general largest 1,000 stocks. And this is all to say, this is just because of what's happened recently. The idea to kind of get out of this today that I was hoping people would understand is that you can look at the stock market based on factors. You can look at it and say which factors have done better recently, but then you could say which factors tend to do better in general. Because what I will tell you is that the growth factor hasn't been the factor that has done the best over time. And in terms of the size factor, large companies haven't also done the best versus small companies over time. It just so happens right now where we're sitting is that is the case. So then it's up to you to decide, is that going to continue happening? Will just throwing money into the largest companies continue to make more money than throwing money into maybe some smaller companies also, mid-sized companies, right? Or do you want to make the bet that just the large companies are going to be ones that are going to win? So the way I see it, I don't think that the largest 100 companies are going to be the ones that are going to do the best like going forward from here. So I wouldn't invest in OEF. I just want to shine light on the fact that there are factors. The size factor has done better. In terms of having larger companies and smaller companies, larger companies have done better. And at the same time, growth has done better than value in recent memory, which also has not been the case in the past. In the past, value has done better than growth. Small caps have done better than large caps. And here we are, where kind of the opposite has been true over the past 10 years. But if you look back in market history, if you go back 100 years, it's not the case. What will be the case in the future? Not 100% sure, of course, no one knows. But what I do know is that I want to use factors to help me understand how I should be investing. Now, speaking of factors, I've talked about value, I've talked about growth, we've talked about size in this, but there's another one called quality. And if you want to learn about that factor and see an ETF that does use that factor, watch this video right here.